It's Liberation Day. Happy Liberation Day, Cameron. You came back right in time.
Yeah, Simone Bolivar, who? Yeah, and I want to be careful. I don't want to get up
Matt,
on a.
really quick, did you repost this to your ex?
I'll get that done in a second.
Okay. All right.
And by that we mean ex social media, not an ex-wife or spouse.
Oh, well, yeah. I could have said Twitter.
All right.
Okay.
Now we're past Twitter. This was also in the last week, like a lot of big things happening. X was absorbed by XAI in a capital markets or a private markets transaction. Let me see how to retweet this. This one's not showing up in my feed.
Go to Build Markets. All right. I was really excited about being liberated, Cameron. I jumped the gun. So
All right.
um,
There are people who will watch this in the past, so we don't want to waste their time, or in the future. Sorry, I'm time traveling here. It gets confusing. Um, okay, so the takeaway. This could get very long, but I'll just start with this. Um, I'm disappointed in my peers in the financial services industry. You can count how many individuals, highly paid investment professionals, staff, etc., over-credentialed out the wazoo, and to not see this one coming, or to walk into that event post-market yesterday and have this type of response today in terms of, hey, asset pricing, client portfolio positioning, all of the above. It's quite frankly disappointing. Like, to put this in the analogy of like a quarterback making a pass, looking for his wide receiver to get open. This one was telegraphed with the quarterback's eyes for a good 5-10 seconds, just staring down the receiver. And the fact that no one apparently in the financial industry saw this coming, or we were completely caught off guard. It really is. It's like, what movie are you watching? Like, just to start with, to think that this idea that this administration wasn't serious about these tariffs. Like, did you actually watch any of the Trump team's campaign rallies over the last year? Like, it was very clear that this was like the tariffs were going to be a key platform issue or economic tool used by this administration. We even had a delay on the deadlines, and he said April 2nd, giving you more time to prepare. Yet when it comes to it, like, you see what markets down almost 5% today. And so if I'm looking at a financial advisor out there and you still have your clients, just hanging out there on a limb in the Mag 7, take it. Well, now if you look at information technology, that if you're overweight, you're even worse than 4.82% on the S&P 500. You're down 5.43% today on just the infotech sector. You're losing purchasing power for your clients. It's like, what are you doing? What are you paying attention to? And this is just, I feel like I'm a parent talking to a child who's making the same mistake twice. It's like, no, come on, you learn now. Now the message has to be like, I'm disappointed in you, to hope that you start getting better effort, better results, or to ultimately get a better result.
So
But
is it one like I guess counter argument to that people felt that the tariffs would come in on the lower end and towards that 10%. Maybe it's flat, but it's just around that 10% range, and to see, I think it was
Well,
34.
markets pumped on that, Cameron. Like when he started with the 10% across the board, and risk assets after hours pumped. And then he kept talking, and then he brought out the chart there, and that's when everything dumped. So yeah, they thought it was going to, right? I mean, they thought they were going to get off easy, I guess, or we thought we were going to get off easy.
yeah, and I'd say if this caught you off guard, you fundamentally don't understand this administration's policy, but it's even deeper than that. You don't understand what's going on with the sovereign debt situation, international foreign exchange, international trade. Like, you really have a lot of homework to do to catch up, and it really depends on where you get your news, your information, your what analysis you're conducting, or at some point I kind of question, like, is there any analysis being conducted? Like, if you're still in that 40 to 50 year bull market paradigm, like just say like target date funds, passive investing paradigm, where all you do is just, you don't care about price, you don't come up with any analysis of forward-looking expected returns. You don't make any capital allocation actual decisions, other than you just buy indices. It's like, all right, this should be a wake-up call that this new environment, which COVID kicked us into, like the degree of difficulty went up. Instead of like now you were like moving through life or the investment landscape with a tailwind at your back for 40, 50 years. It's the opposite now. You've got headwinds. And I just hope today, like this, if you were caught off guard today, I hope this like is a stirring wake up call, to shake you out of it, and to realize maybe, hey, my perspective, my understanding, what I've been doing for 40, 50 years isn't working anymore. Maybe it's time to get better. I just, hope that maybe this is a rallying event for how our industry operates. But that's my my focus, or that's my take within the context of the U.S. based financial profession. Now, on the bigger picture, you've got major things revealing themselves in the response to this. Maybe we can get into that next, Cameron. We talk about the dollar and we talk about duration, and we saw big moves happen in those two things this week. So I'll start with the dollar. Remember 3-4 weeks ago on the episodes, we talked about the dollar response to the Trump-Zelensky press conference, the Friday afternoon White House disaster. I don't know if that event has a nickname, but it seems like something that should, just for future reference, because that's how big this was. But that kickstarted the change in defense spending policies for the European NATO country members, which just was a game changer, quite frankly, in both sovereign debt and also foreign exchange. We saw a massive drop in the dollar that week, coming out of the kind of the post-election rally in the dollar. We've given it all back almost at this point. And after a couple of weeks of kind of counter trend, smoothness, Yesterday's news, we saw the dollar break lower again and hard. International money center banks are basically telling you they did not like this yesterday's update for $1. That does jibe with the direction that the Trump administration and notably Scott Bessent want to see the dollar go. Ideally, I think that you're looking at them wanting to see a weaker dollar over the longer term. Now, you don't want to take it all at once. Like too big of a drop has some potentially tough ramifications on prices within the U.S. and the potential to add a destabilizing force. But over the long term, you'd say two things. If you're thinking about what is this Treasury want to accomplish for the remainder of 2025, and at this point, you talked about this last week. If everybody in markets knows the moniker, don't fight the Fed, don't fight the Fed, don't fight the Fed, right? You don't get in front of the steamroller. It's the same thing right here. You had an administration and a Treasury come out and say what they want. Like they want a weaker dollar, they want Treasury rates lower, and you start to see how policy aligns with that if you actually start wrapping your head around it and not just listen to shouting heads on CNBC or whoever is on the cable news channels these days. But had you actually, heeded that advice, don't get in front of the Treasury, right? You've got this massive institution. They want to see these two core inputs go a certain way. Take them at their word, right? That's exactly what we got. So the fact that like anybody should have been surprised, like I don't. It's tough. It's tough to have sympathy, and this let's take this as a kind of a rallying event within the financial industry. It's time. It's time to take this seriously. Adjust your priors. Get on the same page. Otherwise, there's probably more tough things in store for you and your clients if you don't wake up. But I will say this: so the long-term upward channel, like since the global financial crisis of 2008 that we've seen the dollar in, we talk about this extensively, right? We watch this very closely. If you look at the midsection of that range, I don't have it highlighted this week because we fell out of it. I'll talk about that in a second. We fell out of that Goldilocks range in the kind of right in the sweet spot of this channel where the dollar is functioning smoothly, which means global capital markets and international trade is generally functioning more or less smoothly. Flows are smooth. We saw after the events yesterday, the announcement of the policy, we saw the dollar drop into what I'd call the too soft zone. The dollar's at the low end now of this long-term uptrend channel, which is what you see at the bottom of a dollar credit cycle. Like it's consistent with that. So, for example, if you look at the chart, say 2020, 2021, you see the big U, and we bottom in 2021 with a weak dollar. How did we get there? We cut rates to zero, and we did a boatload of monetary and fiscal stimulus, a massive amount of QE, massive amount of fiscal stimulus with the CARES Act. That took the dollar lower, and that easing in the dollar is really what you expect or what this system requires at the slowest point, at the trough of the short-term credit cycle. We're getting into that realm where the dollar wants to go weaker. But if you'll notice, nothing we've done so far has been, massive QE or cutting rates to zero. We did cut rates by, 100 bips in the between September and December of last year. that's been on pause. We did show last Fed meeting in March a reduction in QT runoff of Treasuries specifically from 25 bill a month to 5 bill. But to get here, to get the dollar weakened, notice it hasn't even taken significant rate cuts or any balance sheet expansion from the Fed. And we're already there with the dollar weakening. So these forces are already happening. You've got a setup that looks like what you should expect for the bottoming of a dollar credit cycle. This isn't something that should necessarily surprise you, but if you're just paying attention, you'll see the how, and you'll maybe have a better idea what to look for. Any questions there? Maybe Dave, Cameron, is there anything maybe I could be more clear on?
I was going to ask, so you've kind of alluded to the fact that there hasn't been any QE yet, right? That has even caused this big drop in dollar strength, so, or has caused dollar weakening. So are you implying that in the future, if that does start to happen, this will even drop further? And how do you view that in terms of the broader cycle overall?
Yeah. So that's a good question. So are we done yet? I would say probably not, just given the bid for treasuries. And maybe we go to the next slide where we cover duration. This bid for treasuries, specifically in the belly of the curve, is pointing to a sign that we still have more rally to go. Like, expect the treasury curve to continue to come in, and this aligns with the ultimate policy outcome or economic outcome that the Treasury and this administration want to achieve, which they've been very crystal clear in their communications. They want to see the 10-year yields come in lower. They want to see Treasury rates come in lower. They want to see the dollar potentially, ultimately, over the longer term, weaken. And then you have to piece together from there what they're doing, the method behind the madness, if you will, to get there. Let's talk about the yield curve, though. We got the current in dark blue. Orange is 1 month ago, and then cyan or teal is 1 year ago. First thing I'll note, the long end rates have not changed that much. Like, just if you look, like, this is just a snapshot, 3 points in time, and the long term rates have been moving. But this kind of anchoring of that 30-year point, it's pretty consistent. The volatility has all been, or downward pressure has all come in at the belly of the curve, and then it's only started to price through with the rate cuts on the overnight rates in the last 3 to 6 months. But they're, from the perspective of how these markets are behaving, there's still more to go for the front end to come in. But if you look like that key trend, I would say, on the hesitance of the long end to budge is the one dog not barking. When I say don't get in front of that steamroller with the Treasury. In my point of view, that 30-year not willing to come along, that's your dog not barking. And what we mean by that is, Dave, you're probably a better expert on this and where that analogy comes from, but it's basically like your warning sign.
Yeah.
But it's the absence of something happening that should be causing concern.
Yeah. Yeah, maybe the dog should be barking, I think. But that was an old Amazon thing. So yeah, that's good reference, Matt.
It comes from an interesting anecdote in history. I usually like to have those, like, where things came from, the urban legend. And there's an interesting story behind it. I can't pull it out of the cobwebs today, but maybe sometime I'll look it up and get a refresher. I remember it being a kind of an interesting story. But what we've seen, especially this year, especially since Trump took office and these policies started to get implemented, the plan started to get implemented. You've seen the belly of the curve, especially when we say the belly. Think of the belly as basically like 2 to 3 years all the way out to 10, but it's really like the 3 to 7 year. Like there's the front end, the long end, and then you got the belly. So the core of the belly, 3 to 7. And you've seen a massive bid in treasury bonds in that 3 and 5 year range, especially since we last recorded. We saw the 3 year trade inside of 4% earlier this week, even before the announcements. And then with today's massive drop, we have the 3 year trading at about 3.65%. So if you think in a world with 2% inflation target that we can't hit, like we can't get down the year-over-year CPI rates from, to actually hit that 2, the market is saying like they're really bidding for the short term, 3 years, 5 years, et cetera. We don't know exactly how long, but the hedging activity is concerned about the slowdown in inflation, for one, potentially coming from these tariffs, or you could say deflation equivalently. And then second, a slowdown in growth. But that is driving your belly yields lower. Treasury markets are kind of communicating this in the intermediate term time horizon. But then what they're saying on the long end is potentially signaling that there may be some lack of belief or credibility that those same things that slowdown in growth, slowdown inflation, are actually going to carry through for the longer term coming out of these policies.
And so do you think that's maybe a commentary on the political situation, how these tariffs are implemented, or is this more of a, people maybe don't understand fully the implication of some of these tariffs? What's your kind of opinion on why that isn't flowing through on the long end of the curve?
Yeah, I think part of it is revealing of the actual plan and implementation. So when I say this, like this administration, as much as, if you watch cable news, what you're going to be told, or the weekly Tonight Show, whatever, commentators, the narrative that's presented really kind of treats this administration and Donald Trump himself as an agent of chaos, which is part of the technique, but it mistakes that specific technique as lacking any intent or planning, right? It just seems like, hey, this guy is like the Joker or something like that, who is only here to just wreak havoc. And that's potentially, if that's the way your analysis is conducted or built on that as one of the core principles, like you're going to miss the implementation itself. It doesn't look quite as thoughtful as maybe what you're used to, in terms of planning and tactics, et cetera. But, probably by design, it's meant to come off, or it presents itself as chaotic and unpredictable when there really is a set of, procedures in place. And when you look at that, kind of what the bond market is pricing in on, hey, growth and inflation slowing in the medium term or intermediate term, like that's materializing in the belly of the curve, the front end coming down. Why would it not come in? I think it's revealing the timing and implementation of the action plan itself. So what do I mean by that? And this is where you get into a little bit of trying to read between the headlines. Some may call it speculation, right? But if you don't have a good kind of framework and kind of base level set of assumptions, your predictions will be totally off. And then if you go to the extreme, your predictions will be so far off that you're losing clients' capital at the clip of 5% in a single day, right? So yes, there is a bit of kind of forecasting involved, but it starts from understanding the context and getting down to first principles. So what do I mean by that? All right. So these tariffs are part of a broader framework, right? And it all kind of spills down, like the straw that stirs the drink is the sovereign debt situation. The fact that this credit system increasingly relies for, as the final backstop, the U.S. government to keep going more and more and more into debt, right? So you think about action plans, what's going on with, the gold markup as well and imports into the United States. If you kind of just treat these all as separate events, like none of it makes sense. But if you try to think about them logically and what's being attempted to be accomplished in the end, you'll start to see some method revealing itself, some sanity in the madness. So what do I mean by that? Why is the gold being reshored into the United States? Why is so much physical gold coming in for delivery, right? Why is gold on such a bull market? Gold exists to reprice credit claims. Like when a credit bubble becomes unsustainable and you're getting less and less bang for your buck out of every incremental unit of credit creation in terms of economic output, and you have more and more trouble servicing the debt, eventually you need something to rebase the credit claims against. You need to recollateralize against something, right? A big part of that something, and this is going on with the broader story of gold accumulation by central banks, is you get gold inventories, gold stock inside of your sovereign. You reflate on top of that. You've debased your money, right? You've inflated part of your debt problem away, but you need to close off your economy, like in goods and services, but then also in your financial economy and capital accounts to keep that inflation from walking out the door, and ultimately, like the costs of that hitting your public, your citizens, if you will, under your sovereign jurisdiction. You want to keep that reflation kind of hermetically sealed inside of your borders to as great a degree as possible, right? So when you think about it, one, why is there more gold coming in? Because we're bidding it up. Like to get this amount of gold, taking physical delivery, you need big balance sheets behind it. You need big buyers. It doesn't happen without the sanctioned approval of the leadership in your financial system, but as well as your political leadership and probably the Fed as well, monetary policy. They would have to be you would have to have buy-in to get this result kind of worked through. So you bring in all the gold. If you're going to rebase the credit stack against that, you're going to remonetize gold. And gold's been in a massive bull market. I mean, you could say this phase since November of 2022, but also since the bottom in the mid 2010s, coming out of the GFC. You want to keep that kind of reflation that you conduct, like rebasing the credit stack to make the debt payable, the debt within your economy, both private debts and public debts, serviceable. Part of it is going to come from marking up the gold, and then when you do that, you want to lock down. so that that purchasing power doesn't walk away or leave your citizens' savings, because a lot of their savings are tied up in fixed income and credit within the United States, domestically, and then also the stock market. You want as much of it to stay within the closed system as possible. So you do things like, all right, what are the tariffs effectively doing, right? Let's say it's the apples to apples same good, something that can be produced both domestically and abroad. Just pick a widget. What you're actually doing with the tariff, yeah. So you've got a market clearing price. If assume costs go up to some degree, but let's say there's an incremental. I've seen some analysis saying 1.8% CPI impact from these tariffs. So let's say prices rise by 1.8%. Your domestic producer just captures all of that as revenue. Nothing changes in their tax code. Granted, the next step in this implementation plan is most likely going to be tax policy. That's coming. So your domestic producer, really apples to apples so far with these tariffs, nothing changes on his or her cost structure, right? The clearing price is a price taker in the economy for a commoditized good or service. That'll just inch up, just based on where the clearing price is in the market for their specific good or service. From the foreign producer, what has to happen is they sell their good. Let's say it enters a port to a merchant, a trader, an importer, who now has to face, in the worst case, the highest tariffs on this list are 94%. I saw Madagascar, I think, was the highest. Let's say it's Madagascar cinnamon or something. I don't know. Let's say you also have cinnamon production in the United States. I don't know if we produce cinnamon bark or not. I don't know if we can here. It's not like coffee, right? Coffee, we produce some coffee in Hawaii, but our coffee is pretty much all imported. Our bananas, all imported, stuff like that. But let's say it's the same good, apples to apples. The clearing price is the clearing price. If you're the importer, you know what you can get on the open market, more or less, as a price taker. You now have a 94% tariff. So if your producer from a foreign country wants to sell to you, he's going to have to take less. He'll have to take fewer dollars, right? So if they want to keep competing in the U.S. market, on the net, they are going to get fewer dollars. Now that assumes that the price impact isn't it's incremental, it is probably upwards, but is it de minimis or is it hyperinflationary? That effect is what you have to wait and see. And I think it comes down to, for each specific good, to what degree is the U.S. producer cost competitive, is where that impact shows up. But on the net, what you would expect here is fewer dollars being sent outside of the U.S. economy is what you're doing. So effectively, what you're doing is you're clamping down, you're closing off the U.S. economy more and more. So if you start viewing these policies in tandem as the U.S. seeking to obviously say protect or isolate its own economy, or its dollar, if you will, its capital account, these things start to make more sense, and you can, hopefully make better predictions. Now, the tough part is, as a U.S. based saver, right? You measure your purchasing power in dollars. Most of us still do. Some are tracking in Bitcoin for those early adopters, but for the most part, tracking your purchasing power in dollars. The tough task in this environment is, how do I invest or save? Where do I save to maintain my purchasing power through time? That's where this becomes a very challenging exercise. So depends on how much pain is ahead. This is another thing the Trump administration has been very clear about in their communication. They fully expect there to be pain.
Yeah.
So anybody surprised that they're going to have to put up with something like, I'll tell you this. How much pain do you think you've felt yet? Like it's barely like, is it a pinch? Like this is not, someone was saying a tweet I replied to today. I think it was actually like a state level public official in Nevada saying that this terrible economic policy had created pandemic level pain. It's like, no, this isn't even close yet.
No.
Like you saw in the second week of March and during the pandemic, drawdowns of 7.5% and 9.5% in the S&P 500 in the same week. Like that was 2 out of 5 trading days.
Well, that's not real economy. That's not real economy pain either, right? That's asset economy. That's asset price pain, Matt. So, but to hit on a point you made earlier, I think everyone has those group texts, right? You have your buddies, you're chatting back and forth. No surprise, we're out here in Seattle, so a lot of people out here don't appreciate Trump, don't like Trump very much. Get a lot of texts on that, and not to call people out, but I hear a lot of things about, oh, Trump's a moron, Trump's dumb, he's dumb, and I think I shot back, and I'm not a huge Trump supporter myself, but I did shoot back and say, assuming somebody, especially somebody in power or somebody that you may oppose, is dumb, that's a path to get wrecked. I mean, it's and that goes back to your point. It's that I think you put it perfectly. It's chaotic. It looks chaotic. It might be a little sloppy in implementation, right? There's definitely been some slop, but to just blanket say, oh, this is dumb, is you're not actually paying attention to what's being done here. Side note, I'll let you get back to it, Matt, but the dog didn't bark because he knew the killer.
Oh, yeah, that's right.
I had to look that up. It was Sherlock Holmes, and that's so it's basically it's an inside job. Is that the dog's not barking because the dog knew the person.
Yeah.
Sorry, it was an aside.
I knew it was somewhere. I love Sherlock Holmes novels, some of the best. But yeah, that's exactly right. All right, cool. So if you want to go to duration. Yeah, that's back to that, David. Don't do lazy analysis, right? Don't let your bias and emotions get in the way. All right, duration is the other key. We talked about the dollar first. Dollar softening. This is exactly what you expect going into the trough of a credit cycle. Usually you see some sort of easing hitting the dollar. This is the duration chart of the May 2050 bond. I like to cover this one rather than the just the 30-year long bond treasury yield, because I think the price chart on this bond, from a signaling standpoint, packs in so much more information where you just have price to go off of rather than yield on a bond, which can has a lot of adjustments you need to take into effect to really see the trends. The key thing this week, so there's a dotted green line. It might appear kind of solid, sloping downward from top left to bottom right. That was the prior top of the channel resistance, if you will, for the price of this 1.25 coupon treasury bond that the government was able to issue in May of 2020. Lowest coupon bond on the 30-year ever to launch in the treasury market. So we've clearly at this point, after kind of poking our heads up through that resistance line, it's set further back on the chart. I zoomed in on the most recent 2 years to really get a sense of what's going on. That bond is signaling a breakout against that long-term downtrend. And so when I talked in prior weeks about we were looking for a very clear signal to tell, if you look at the channel that's highlighted in blue, the uptrend channel that's starting to very clearly take form for long-term duration over the trailing year. What we were looking to prior to this week, like the last time we've met, we've been talking about on the times we've opened the show looking at duration. We were waiting for this market to clarify direction on which way long-term treasury rates were going to go, and where the long-term rates go will help inform. It'll pull the rest of the curve, from the belly along with. Now they won't go exactly in unison as we've kind of seen today, and the yield curve charts we showed just a second ago, but the trend looks like we've come out of that wedge. We've broken to the upside, which suggests that treasuries are going to continue to see a supportive bid. How long this lasts is always TBD. These trends can break down. But to me, it looks like we've broken to the upside in price for long-term treasury bonds, which the other side of the coin on that means yields want to come lower, right? And that jives with what you see on the front of the curve. Overnight rates, short-term rates, Fed funds, et cetera, they want to come in. They're saying, hey, is there 75 bips of cuts, 100 bips of cuts? The front end's going to come in. Belly has already seen a tremendous rally. What this looks to me like is long-term rates are showing their hand here, that treasuries want to come in response to the policy steps that this administration is taking. So take them at their word. This is what they said they wanted to do. Markets are now starting to signal that that's what they're going to get. Now there is some reluctance. If you'll notice, every candle on this breakout, the daily headline, the last 3 days has pushed yields further and further above that green resistance line, but they've always been sold off in the market session. We saw it today too. The 30-year today closed not quite at its intraday low, but they didn't close. You're not seeing a close into strength, like a close into another high. So maybe there is. We've got an NFP jobs report coming tomorrow. We've got other data, other shoes to drop. These tariffs go into effect on March 9th. I'm sure there will be other headlines in between. So don't be surprised if you see some softness and or some of the yield given back in long-term treasury rates. But if you're preparing your investment outlook for the year ahead, the remainder of 2025, this is when you don't swim upstream in the river, right? Follow the current, and the current says treasury rates want to come in.
So maybe, Matt, explain a bit. You don't have to go into super detail here, but it's very clear to me what you're saying. So if you're a PM, you sit in the seat all day, how are you thinking about positioning, maybe portfolio-wise, to make sure that you're ahead of this as these shoes start to drop?
Yeah. So when you are all right, so that we don't operate, on the way we manage funds, client accounts, et cetera. We don't just follow, glide path investing. You're going to buy X% of S&P 500, X% in Bloomberg Ag, rebalance every quarter, rinse and repeat, hit the golf course every day. That's not how we operate. That approach may have worked for 40, 50 years in a bull market in both asset classes. That was really responding as an output of the core underlying drivers that I think a lot of our industry didn't fully appreciate or understand. But just knowing basic things like what is the primary trend, right? The primary trend right now well, if you zoom out, the primary trend on Treasury debt is still lower, right? We'll see, but that sell-off starting in August of 2020 to the lows. The low is on that chart, September of 2023. We still don't know if that was the first leg of a primary trend, and now we're just in a counter trend retracement. That remains to be seen. But for the 1 year, like the next 12 months, just consider this 1 year outlook. Like, all right, call that your primary trend. The primary trend looks to me to be up, which means you want to be a buyer of, let's say, Treasury duration, is what that's pointing to. And then if you can get the trend right, that helps you decide on one day or another, do I want to be, for example, a buyer of duration here? Do I want to add duration, all else equal? Do I want to be more aggressive on responding to liquidity taker requests on, let's say, a credit I own? It helps inform those decisions, and then if you're actually if you're swimming with the current, you have the odds in your favor that total return is going to work out, or more likely to work out favorably for you than if you don't know what those primary trends are.
Got it. And so let's take the counter to this argument, right? So, I think you already alluded to it previously, but you mentioned some folks are viewing this as, oh, it's just Smoot-Hawley round two, right? But you very clearly said, no, I disagree. I think that the setup for that is actually, or the setup for this is actually very different from what we've seen in the past. So maybe can you walk through what you see maybe differently than other folks in industry?
Okay. So when we see Smoot-Hawley, a 1930 policy, you're looking at a completely different systemic backdrop in the financial system and international trade, and then also where the other parties are at relative to the U.S. dollar and the U.S.'s own sovereign debt situation. I think also to go deep here, we'd have to do like a 1 to 2 hour breakout on the 1920s, the credit bubble, the stock euphoria, the policies that stoked it, and then the pullback when the gold got pulled as Weimar Germany, or got pulled from New York and moved back to Europe as kind of the Weimar hyperinflation started to stabilize. There's a long history to go through there, but just for the most important drivers of the situation, you start with where is your credit bubble, and then where is the sovereign. And you can look at things that are very similar in the current situation to, if you just want to foot 1-to-1 with Hawley Smoot, just enough to be dangerous, but then ultimately your predictions will be missing some key variables because you didn't actually, to just go by whatever you learned in your high school U.S. history class and set your investment strategy today to that. That's probably not going to be good enough. That's not going to cut it. But if you just start from, all right, you do have a similar situation to credit bubbles, right? There was a credit bubble that popped in October 1929. Now, what actually happened there was the sovereign bailed out the insolvent U.S. financial system. That's why, Hawley Smoot started like it was a Herbert Hoover tenure initiative, as my understanding. It was 1930.
Started in 29. It was supposed to be it was a farmer constituency. It was supposed to be the farmers were getting hit by, I think it was European ag being imported. So they were not able to sell their wares at market. You talked about this before. They started losing their pricing power. They also, the value of their land was going down. So it started with one very specifically aimed tariff to protect American farmers. once it got to the House, they started tacking onto it because, and the story, as I understand, is that Hoover kind of went along with it and didn't push back because the Republican House, the Republican, what do you call it? You look at today's politics, the Republican body, electorate, voters were strongly protectionist. So all these members of Congress started tacking on, oh, well, we should do this. It ended up getting to, I think, 20,000 different goods. So it started as one and it ballooned to this massive protectionism thing. And actually Hoover did have pushback from a bunch of people, but he didn't have the political capital to veto it. So anyway, sorry, that's an aside.
So what happened was you have similarities in that there was a credit bubble in both situations. In the Holly Smoot situation, it had popped, right? It was done. The system was deflationary at that point. And then you stacked tariffs on top of deflation.
Yeah.
It didn't work. The ultimate policy prescription that was enacted when FDR came in to pull out of or start, pulling out of the Depression, you saw the government come in, which was at a sub 20% debt to GDP, right? Like a very good balance sheet situation. The sovereign made the decision to reflate the system, but in doing so, it took custody, like essentially, it bought out the gold of the financial system, and that's where you lost the gold standard, right? So that's like the beginning stages of the system, the framework we've really been on for nearly 100 years, a U.S. Treasury debt standard, right? The Treasury debt became your base money, or it started to become the base money of your system, and the Treasury took custody, if you will, of the gold in the system. That's where you saw gold marked up from, was it ever dollar for dollar? Was it $1, 1 ounce of gold? I forget exactly what it was, but at that point, I think he marked it up to like $33 an ounce, and with Executive Order 6102.
35, something like that, yeah.
The silver dollar standard, I want to say, yes. And then gold, I forget what it was before and after. But this is what we're talking about, marking up gold, like you devalue your currency units versus the gold, that's reflation. And in doing so, to get the dollars into the credit system, the Treasury effectively, took possession of the gold, made it illegal for anyone else to own the gold, so that the credit would start flowing freely in the financial system. You would start to see the liquidity start to increase and build upon itself to get that deflationary trap resolved, if you will. That dynamic is completely different than what we're seeing today, which is the other side of the coin. It's the evil twin, where you've got an over-leveraged public purse, the Treasury. If you do debt percent held by the public, it's, this chart shows it as about 100. That's if you take the view of we owe it to ourselves, and these Social Security claims which we put in, or that all nets out to zero. It's not actually true. The government owes the citizens for those IOUs that they've swapped out, if you will, for the private sector savings through the Social Security forced savings plan. That's a whole different beast. But if you just take the backdrop that we're putting in a tariff policy, similar policy, right? It'll ultimately, in effect, result in fewer dollars leaving the domestic U.S. system. Yes, check, both things accomplished. But the backdrop in the banking and credit situation within the financial system, and then the sovereign debt situation. Those are in two different places. The roles are flipped, right? Post 1929, banking and credit was on its back for dead. Like you had massive bank failures, banks, not honoring deposits, frequently throughout the country. And then you had a government who just came to step in because they had the balance sheet room to fill it in. You've seen over the last, this cycle's been building up for 100 years. But post 2008, what you saw was similar situation where the banks were in a credit problem. Government came with the bailout. They reflated the system with bailouts, infrastructure spending, all of that stuff. But at this point, you've got a U.S. financial system not in, fantastic balance sheet condition, but it's nowhere near to the point you were in 1929 and 30 with that deflationary dynamic and life-threatening type of situation for U.S. banks. That's really not the position that we see ourselves in today. But I would say the U.S. at the sovereign level, the fiscal situation is the exact opposite of where we were in 1930, with a very, going into it, a very conservative kind of management. Post-Civil War, we spent a lot on World War I, but then you had very conservative Congress and presidencies throughout the 1920s. You just had a lot of fiscal room for the sovereign to come in and help. So eventually, with the Hawley Smoot tariffs and all of that, the legacy of those was, hey, yeah, it didn't work because the context of the problem was was set up for it to fail. It's exactly the wrong policy tool at the wrong time. That doesn't mean that this policy tool is going to be perfect or effective, but what it may work. Like history will play out at the specific objectives that it's trying to accomplish. We've talked about some of those. But what we can be pretty sure of is in two different situations, if you use the same tool, it's unlikely that you get the exact same results, right? And if you're going in with your framework, your analysis, your investing, thinking, or not taking that into account, you're going to make poor predictions with your analysis and decision making.
Well, yeah, Cameron, do we want to go on to the next slide here about the consumer? Because I think that's a good segue on. Last week we talked about where does this start hitting the consumer? Like when do you start seeing a slowdown in things like housing, which is a significant part of GDP? When does the consumer spending actually get hit? And the tariff aspect is massive here. Like as a follow up to last week's conversation, before we get into this, Matt, you can look at this housing data. Maybe we'll wait a month or two and do another update. But you can continue to see the weakness at the top end of the market. Matt knows this because I talk to him on a daily basis. But just going around my neighborhood, I've seen the price drops happening on the top end. So we're talking like the really nice luxury. We talked about Toll Brothers. We talked about Lennar. Some of these are custom builders, but on that top end, when this is Seattle, it's an expensive market. That top end is fueled in large part by the wealth effect. Wealth effect fueled a lot around here, especially by the big tech. Now, obviously, they've been on a run, right? So this pullback hasn't wiped people off the map, but you're seeing it now. You're seeing the top end of that housing market get hit. You're seeing price drops. You're seeing delistings. So it's definitely the cracks are there, or the top end has cracked. But
well, the top end tends to be a buyer who isn't, I don't need a conforming Fannie Freddie type of mortgage.
yep,
It's going to be, all right, maybe they can finance it with a jumbo, but a lot of them are just cash buyers, and
yep,
they have the investment portfolio, or they can take out a
yep.
margin loan, whatever. And
Oh yeah,
when your brokerage account is down over 5% in a day and
oh
trending
yeah,
down on the quarter, you don't have that room to go out and buy that, mid
yeah,
seven figures or, really high end home. So that makes
yep.
sense why that market would be, maybe if not rolling over, starting to soften.
Softening, yeah. And what's interesting is it's taken a sustained period of high rates because you've seen the market continue to go up. So anyway, that's anecdata, but I know we have these slides up here. I want Matt to comment, but on the 28th of February, and this is something I had to check myself, that you have this. So you have GDP now. It's an Atlanta Fed. It's an estimate of where they think GDP is going to net out. But on the 28th, everyone was talking about this, posting this on X, that, oh wow, this estimate dropped. And my take here, Matt, is that the where you saw that drop was on tariff threats or tariff projections. Um, Importers started to front run and just started like importing goods, and so your net exports took a hit through from then until now. Now you're at quote Liberation Day. Um, so now that we've been liberated, the thing that hasn't dropped, and it's hard to see because it's all blues and it's weird shades, but what hasn't taken a hit, yeah, there you go, is the consumer spending portion of this. But now consumers are going to get hit because I don't know about you guys, but I struggle to buy a lot of American made stuff because it's not possible unless maybe you want a Ford or a new car. But now we should start seeing that PCE component come in. And so Matt, I don't know if you want to riff on that for a little bit, but
Yeah, I'd say the two biggest potential like chinks in the armor here to this implementation plan that this administration is running. Number one, I already talked about this. If the long end rejects it, right? That's your sign. The market is throwing your signal that we're not going along with this. And that's like case in point to just say getting treasury rates to come in, for the front end or the belly. That's one thing, because most investors that kind of 3 to 5 year outlook kind of aligns with most people's risk tolerance and just time horizon for the short term. 30-year balance sheet capacity, like, that's hard to build out. It's a higher degree effort to get one more borrowing capacity built at the longer you go on maturity on a bond issuance, without having to rely on the Fed to just buy the paper to bail you out. So that's number one, is the long end of the Treasury curve going to go along with this plan? And so far, I would say there's a small amount of data like revealing itself that there may be some hesitance here for the long bond buyer to come in and fully believe in the inflation and growth slowdown for these policies and what they're achieving. The other side of that is kind of the short-term section of the barbell, which is consumer spending. Does the consumer hold up? U.S. is a consumption-based economy. 70%, give or take, of GDP is private sector consumption. And if in response to all of these policies, the net is the consumer just pulls back their wallet slows down spending, and creates, I don't think there will be a nominal recession, because, well, sorry. Yeah, a nominal recession itself, a real recession that may or may not take place just because of the price mirage. But a nominal recession, actually negative GDP growth, would actually make the debt service problem, for this credit bubble even harder for the system, which means every time you get into that, you have to, as the sovereign, the buck stops with you. You have to kick into high gear, do more deficit spending. It just makes your whole problem worse. So the minute you get a whiff that there's actually a nominal recession forming, it's kind of like if you know what's good for you, you'll nip it in the bud ASAP.
A whiff of a real recession or nominal?
Nominal. Yeah, real recession, that's all just a mirage. The real world, in our real world, it's the actual goods and services we're able to consume, the quality of life. The nominal is what hits the tape in the financial system, right? Does the debt get serviced or not? So you cannot take a nominal recession. It just makes your problem worse. So if you start seeing consumer spending pull back nominally, that is where you probably start to get worried, and you need to do something to fill that in. And you can fill that in through price inflation or some sort of policy approach to try to get spending, consumption back up. But that's probably the number 2 on my list of things I'd be watching if I'm running this policy from the White House. So yeah, the fact that you saw that blip, it may just be a data blip, but it did look like our consumption effect was very slightly positive in Q1 as of like a week or two ago, and then it starts to inch down, then it flips negative. If the consumer, as these things are really hitting their front page, their pocketbooks, and they start to pull back en masse, that's where you've got to get in front of it very quickly. If you're Congress, the U.S. Treasury under the executive branch, and then the Fed is where you'd want to get out of that gravity well ASAP.
All right, well, I think we're going to switch gears here a little bit.
And the fact that your Nike shoes now have to be made in the United States, probably, no, they don't have to be.
Well, it's tough for them to move that over here.
Yeah.
I've got a couple pairs of the super shoes, and those things are like $260 before the tariffs, so I might need to get on that if I want another pair.
Yep. So that's just case in point, nominal may maintain itself. The real purchasing power, the real spending, measured in like unit volume of goods and services, purchasing power, real standards of living, at least in the short term, probably take a hit.
So like I was about to, kind of switching gears here a little bit, but still related to where we're at in the overall cycle. CoreWeave announced their IPO very recently. For folks who were following that at all, I think there's been a lot of media attention on whether or not it was a good idea, whether or not CoreWeave has any prospects as a successful company moving forward, et cetera, et cetera. So a lot of positive and negative press. But I think one of the things that clearly came out from all of this is this allusion to WeWork. Not saying that it exactly is WeWork, but just saying that there are some similarities potentially with the timing and how they're going about their IPO. So maybe Matt, I know you had some ideas on this piece. Could you speak to kind of what you're seeing that compares CoreWeave and WeWork's IPO timing, process, etc.?
Yeah, and just to be clear, WeWork, CoreWeave, 2 separate businesses here. Same way I made the statement. Don't take Holly Smoot and what we saw yesterday as the same thing and then make the lazy conclusion. this is I'm going to get result B. That's not what we're saying here. That's intellectually lazy. What I do think is interesting to dive into is using an IPO as a signpost of the broader capital market cycle. What do I mean by that? Usually, if you're if you're going to IPO your shares, take a private company public, you want to do it in a situation, ideally, that gets you the best possible price. And when is that? If you had perfect hindsight, timing and market conditions, you would price at the top of the window of the bull market and whatever your business is, or broader equity market conditions. Now, clearly, with Mag 7 and technology companies and a pretty significant retracement here in Q1, this is not an ideal time. If you're talking to your investment banker and if you had everything lined up in your corner, you wouldn't float your shares right now if you were concerned on pulling top dollar off. Now, to think about this on a good example of timing your IPO, when you don't need the capital and you have the benefit of waiting until conditions are optimal, you'll do something like we saw with Facebook, which everybody knows now is Meta. But back in my day, they were Facebook. Facebook showed up as a company in, I want to say, like 2001, 2002. And within a few years, they were it was very clear that they were going to have great advertising revenues and strong user growth for the foreseeable future. They did not IPO. This is like a post.com story in its entirety. They did not IPO until 2014, I want to say.
12.
12? Okay, it was 12.
Yeah, it was 11 or 12. Yeah, it's around then.
So they took about a decade before they ever released any shares. And because of the underlying strength of their business, as well as the ability to tap private capital to fund their growth, they got to wait out the 2000s bear market in its entirety from IPOing their shares at a lower price. So the existing shareholders in the A, B, C, D, E, all those rounds got to wait so that nobody had to take a down round. The IPO, they took all the money off the table in that IPO. Out of the gate, I want to say it didn't perform well out of the gate.
It dropped.
Yeah. And
yep.
So they left the public markets like buying at the top tick.
Mm-hmm.
They had to wait 18 months, and then after that, Facebook, Meta have just been on a wonderful ride. But that shows, like, if you can control your own destiny as a company and you have the capital, the financing, you don't IPO into a market where you're not taking advantage of a strong underlying market and getting the best possible price for your shares. That's clearly not the case in Q1, right, of 2025 for tech companies. You would IPO only, or maybe not only, that might be too strong a case, but you're heavily incentivized not to rely on the IPO to raise capital unless you absolutely have to, right? And the CoreWeave IPO, they wanted to go bigger. It's been well known. They had to downsize. It was $1.5 billion. And then I believe NVIDIA came in and bought 250 mil of it. So 1 out of 6 of total dollars raised was from its core, what do you call it? CoreWeave was a main client of NVIDIA. NVIDIA came in for 1/6 of its IPO financing. So interesting setup. Similar situation here in 2019 with WeWork, IPOing into a capital markets situation that was slowing down in half two of 2019. It was obvious at that time that global growth was slowing, treasuries were getting bid, U.S. equities did initially rally in response to those rate cuts. But then as COVID came in and the end of cycle started to materialize, we know what happened with equities bottoming into that environment. But the market, like WeWork, IPO'd because they ran out of financing.
It didn't. Sorry, technical no, but it didn't IPO.
They did.
They did not. They
eventually they did.
They did eventually, but you're Matt. You're right about the intended timing was really weird.
They shelved it.
They shelved it because if you actually opened up the offering documents, it was insane, which was the chart here. But yes, the timing choice was still there. It's still a valid argument. It's just it didn't happen.
A lot of things about
their community adjusted EBITDA number was not well received by the street.
Exactly. But you show up with, it's to keep doing what you're doing economically. You've run out of capital from your other sources. In this case for WeWork, they had to go and attempt an IPO in an environment where had they had strength, they could have waited out for better market conditions. But that was not the case. They had to ship the IPO. They made the attempt. Turned out it was a bet the company effort, and that's when it was kind of the beginning of the end, and this WeWork situation started to unwind. Now, they didn't even get out of the gate. They eventually went into bankruptcy, and we all kind of know how that situation unfolded in history.
We work out of an Industrious, which used to be a WeWork. So that's where Matt's sitting right now. So
and they bought the assets at the bottom of the market prices, and that's generally how capital markets and creative destruction are supposed to work. But in kind of similarities, if you're a large cap company, tech company, you've been in high growth mode, financing that growth for 4 or 5 years. You overbuild capacity potentially, and then a slowdown takes place. Yet you need more capital to keep your machine humming. You could find yourself in that similar situation where, hey, credit markets aren't open, loans aren't open at terms that are economic, or the amount like $1.5 billion, which is the raise that was needed. That was ultimately kind of revealed to be the level needed. Do the IPO, right? So in this case, it did float, and so far CoreWeave is outperforming the Qs in your Mag 7 in about a week since it's been traded. They did move the price down. I think it IPO'd at $40 a share, still trading at 53 today. So it is still a deal where the initial allocations are still in the money. But I think it's an interesting kind of signpost on market conditions. No two credit cycles are fully alike, but kind of the same way that the We IPO was marked the beginning of the end for the 2010s kind of capital misallocation and froth. I think this IPO in this specific window, there's a lot of signal and in terms of following that timing and where the broader AI trend sits and how it couples up to the underlying credit and sovereign debt cycles. So Cameron, I'll let you dive in a little bit to the specifics in the IPO. I know you'll have some insightful commentary there.
I think it's really just kind of backing up what you already said. In terms of the S1 itself, a lot of the commentary that came out of it is noticing, hey, CoreWeave has a lot more debt than we originally realized. And then the further WeWork comparison comes from that mismatch between assets and liabilities, right? So WeWork had a lot of leases, a lot of buildings they needed to be able to make payments on, but maybe not having people come in, sign longer term contracts to stay in those buildings. The same thing was maybe floated as an issue for CoreWeave. I think in the last day or two, their team has already come out and said, no, the way that we actually align our liabilities with our assets is a little bit different from what has happened to other companies in the past, clearly alluding to WeWork. So they're making sure that they call it here, it's a take or pay business model. So customers sign an agreement to pre-purchase an amount of compute over a fixed number of years. That is what they're lining up to each of these loan facilities, right? So they're making sure that they're matching up those assets and liabilities. I think that does explain away a little bit of the debt side of things. Why also could they not take on more debt? Well, because they already have 4 loan facilities going. If you total this up, over $8 billion in lending already to CoreWeave. So that's a pretty big number there. The other piece here that relates to the AI kind of space overall is just that NVIDIA continues to be the juggernaut in the space. You've got AMD that is desperately trying to figure what to do, still cannot figure that one out. Tack on tariffs. I know that the Taiwan tariffs exclude semiconductors specifically, but there's a lot of other components that go into these cards. They ship across the world. As you can imagine, that does have some pricing concerns. Also, just generally, what are the types of cards that CoreWeave is actually buying? They took a little bit of an L last week. Jensen Huang actually went out and said, I don't know why people are buying our old Hopper cards. They're the last generation at this point. They're going to be useless pretty soon. That is what CoreWeave had. That said, they already have the new Blackwells coming in, so they're making the right moves already. I think some of this is just timing, press, all of that. That's kind of negatively impacting CoreWeave, unfortunately for them. But on the flip of that, it's really this question of, well, is this actually NVIDIA trying to support its own valuation? Because ultimately, a lot of these customers of NVIDIA are facing issues renting out their data centers, right? So Microsoft actually last week, or 2 weeks ago, I want to say last week, walked away from several deals they had signed. 2 of those, I believe, being with CoreWeave as well. So you're seeing some of this pullback from the general industry saying, okay, we saw the DeepSeek news. Maybe we don't need to worry so much about LLMs or the specific models being the moat builder, right? In terms of compute itself, you're seeing folks saying, well, maybe we don't need to build that all directly here in the US, or maybe it's just not at a price that's competitive for what they need to do. So you're seeing a little bit of pullback already. Add to that, to everybody's point already, the wealth effect from the general Mag 7 declines. They have a little bit less cash to spend on projects like this. So I think you're seeing a little bit of the worries bubble up. I don't think CoreWeave is exemplary of the AI market as a whole, but I do think it's an interesting, to Matt's point, timestamp of where we're at for AI broadly. Will this be kind of the next phase of us finding out the companies that are going to be building the infrastructure for the future, or do we have highly inflated numbers for all these companies right now where we're maybe going to find out that these were overinflated over the last couple of years? So that's my take on CoreWeave there and how that kind of relates to the broader AI market.
All right, awesome.
Well, we're running up on I've covered a lot of ground today. We're running up on 2 hours. I don't know if we want to do some parting thoughts and wrap this one up. I feel like we didn't quite get through the history of Rome, but I don't know. I think there's just a lot of things we need to follow over the next couple of weeks. It's going to get pretty interesting.
We're not even done with this week yet. We have a jobs report tomorrow.
Yeah.
So
yeah,
it's just nonstop news back and forth.
More,
I feel like.
Yeah.
Yep.
No, I think I was a little bit harsh on the rest of the U.S. Financial services industry not being prepared for this today, but it does take a lot of mental effort and cycles to manage investor portfolios through this. I think it does take a lot more in an environment like this where your degree of difficulty is like an order of magnitude higher to invest capital through, let's say, the 2020s and what lies ahead. than maybe it was from 1980 to 2020. So there is some element of that. It takes more energy, effort, skill, and I guess stamina to navigate through this. So I do fully concede that it is a harder job for the industry in an environment like this. But what is it? Tough times demand tough men, tough women, tough solutions. So hopefully it's a rallying cry for us to raise the bar and ultimately preserve capital, hopefully grow capital through a much tougher environment. But don't expect it to get any easier. What you've seen since 2020 is probably par for the course. This is the real new normal, and we'll just keep forging ahead through it.
Great. Well, thanks everybody for listening to us this week. Again, if you're not following Build Markets, that's our new X account that we're trying to push all these live streams through. Please follow us there. You can also view us on YouTube, LinkedIn, tell your friends, etc. Also, give us feedback. I'd love to hear, if you have any thoughts on how we can improve. We will definitely try to take all that into account. So, thanks again for listening, and see you next week.
Great. Thanks, guys.